So today we're going to talk about milestone number 5 on the Next Dollar Roadmap, which is saving 15 to 25% of your income in tax-advantaged retirement accounts. We kicked off with a starting point, which is creating your first budget. Then milestone 1, which is the fund, that's $1,000 or the value of your highest insurance deductible. Milestone number 2 is investing up to your employer match or taking advantage of any employer matching contributions you have in an employer-sponsored retirement plan or a health savings account, something like that. Milestone number 3 is paying off toxic debt. We talked about identifying toxic versus non-toxic debts, how to focus on prioritized debts to pay them off most effectively. Milestone number 4 is a fully funded emergency fund, so that's taking the fund up to that 3 to 6 month expense range in terms of liquid cash that you have money available to float through an emergency or get through an emergency like a job loss or something like that. Now that you have a really great financial foundation in place, you're ready to begin saving and investing at a level that's really going to advance you towards financial independence. Now, if you want to go back and look at any of the videos we recorded previously on the Next Dollar Roadmap, they'll be linked in the description below. Also, any videos that we post after, that'll be milestone 6, 7, 8, 9. Those will come after this. I will link those as I add them to YouTube, so you should be able to skip forward if you're watching this sometime after this video was posted. Some of the information we cover today will be a repeat of milestone number 2, but it's all related to saving and investing, which is why you'll see some of the same information again. But the primary thing we're going to focus on today is saving and investing in tax-advantaged retirement accounts. And the reason you want to take advantage of tax-advantaged accounts is the potential savings they can generate over time can be enormous. Let's jump right into an example to show you how. So once again, I want to use an imaginary character named Joe Dollar. He has completed milestones 1 through 4 on the Next Dollar Roadmap, including his company's 6% match, which is milestone number 2, and he still has money left over to use somewhere else. So as a result, he's currently debating whether or not he should contribute more money to his company's 401k plan or to open a taxable brokerage account. And Joe's salary is an even $100,000. So in 2025, this means that Joe is already putting $6,000 of the maximum $23,500 that the IRS allows for contributions into his 401k. So let's look at the financial implications of directing an additional $17,500 into that 401k versus investing it in a taxable brokerage account. Now we'll assume that Joe is in the 22% income tax bracket and the 15% long-term capital gains bracket, and that he'll be in the same tax brackets no matter when he withdraws the money. And we'll also only track the value of the $17,500 he contributes beyond his employer match. Finally, we'll assume an annual rate of return for 10% on Joe's investments, and that he will withdraw both contributions and earnings in 20 years. Now, as we evaluate Joe's options, remember that the principal Joe places into his account will ultimately be taxable as income either way. If he accepts the income and then places it into the taxable brokerage account, he'll pay income tax on the $17,500 now before it goes into that account. On the other hand, if he puts it all in the 401k, the $17,500 will be taxed when he withdraws it in retirement. Now, this would be true for a Roth 401k contribution too, but we won't be using the Roth as an example because it doesn't really change the ultimate point. Besides, the end result is the same for Roth or traditional contributions when the income tax rates and interest rates remain the same. So in summary, the only values that matter in this analysis are the gains or growth on the assets above $17,500 over time. All right, looking at the 401k first, assuming Joe puts the additional $17,500 into his 401k, none of the money is taxed going in, so he receives the full benefit of investing $17,500. Now, running the math, in 20 years, Joe will have $117,731.25 before taxes. And after paying 22% income tax on the withdrawal, Joe's $17,500 has turned into $91,830.37. Now, using the taxable brokerage account, the $17,500 that Joe could have put into his 401k is now worth $13,650 after he's paid 22% income tax on the contribution. Now, in 20 years, this amount grows to $91,830.37 before taxes. And after Joe pays a 15% long-term capital gains tax on the growth beyond this initial deposit, he has a total of $80,103.32. That's $91,830.37 minus the $13,650 contribution that he made, times the 15% long-term capital gains tax, means that he paid $11,727.06 in gains taxes for a total of $80,103.32. So in summary, by foregoing the option of using his tax-advantaged 401k, it would have cost Joe an additional $11,727.06 in capital gains tax when he withdraws the funds in 20 years. Or put another way, assuming everything else stays the same, the cost of going the taxable route is equal to your long-term capital gains rate. Now currently long-term capital gains taxes are 0, 15, or 20%, depending on your income tax bracket. And in case you're wondering, long-term capital gains are gains on assets that are owned for at least a year and a day. Short-term capital gains are taxed at your normal income tax rate. Now, the 401k is just one example of several tax-advantaged options available to Americans in order to encourage saving for retirement. Let's walk through some other popular plans and share some of the details of each. So first off, I've grouped together 401ks, 457s, 403bs, and solo 401ks because a lot of the tax rules around these plans are very similar. All of these account types are available through an employer-sponsored retirement plan where you work. In the case of a solo 401k, you're acting both as the employee and the employer, which provides a unique opportunity that I'll touch on a little bit later. Now, traditionally, contributions made to these plans are made on a tax-deferred basis, meaning the money is placed into your account via payroll deduction before any taxes are withheld. After that, the contributions can be invested and any earnings can grow without any tax implications until you make withdrawals in retirement. Those withdrawals are all subject to normal income taxes. All these account types also allow for Roth contributions, which are subject to income tax, but all subsequent earnings and withdrawals after Roth contributions are made are completely tax-free. I'll also touch on this a bit more later. Now, as we pointed out in milestone number 2, about 86% of the time, employers will also make some sort of matching contribution on behalf of their employees. The average matching rate in the United States is just over 4%. Now, the maximum annual contribution to a 401k, 457, 403b thrift savings plan in 2025 is $23,500 if you're under 50. It's $31,000 if you're between 50 and 59, or if you're over 64, or it's $34,750 if you're between ages 60 and 63. Usually there's just one catch-up provision. In 2025, there's actually two, so it's a little weird. Now, additionally, many plans allow participants to make after-tax contributions of up to $70,000 per year, plus the applicable $7,500 or $11,250 catch-up provision depending on those age brackets I just discussed. Now, this ability is plan specific, so you'll need to check with your employer to see if it's available for you. Not everyone can contribute up to this after-tax amount. If you make withdrawals from these accounts before age 59 and a half, you'll owe a 10% early withdrawal penalty. The one notable exception is 457 plans, which you can begin making withdrawals from when you retire, no matter what your age is. You can also get into 403b plans or 401k plans early using the rule of 55. That's another topic, and I've actually got videos on those. I'll link those down in the comments below. The next account type to discuss is IRAs. Individual retirement accounts have been around since the late 1970s, and there was a major shift at that time, basically from a traditional defined benefit pension toward the defined contribution plan. Now, you do have to have earned income in order to make a contribution to an IRA or have a spouse that does, and those contributions can be made on either a Roth or traditional basis. Now, you can open an IRA at almost any brokerage or investment company like Fidelity or Vanguard or Schwab, something like that. And the contribution limits for 2025 are $7,000 if you're under 50 or $8,000 if you're 50 or older. Now, similar to most employer-sponsored retirement plans, you have to wait until age 59 and a half to make penalty-free withdrawals from an IRA, but contributions made on a Roth basis are always available for withdrawal. There are several hacks and nuances to IRAs that I'm not going to get to in this video, but if you want to see those, I'll link several in the description below. Next, I want to talk about health savings accounts. I'm going to qualify these as a retirement account, and I'll explain why in a second. HSAs are unique in several ways, not the least of which is their ability to provide a tax break on contributions, earnings, and withdrawals. Additionally, if you make contributions to an HSA through payroll deduction at work, you can save another 6.2% in Social Security taxes and 1.45% in Medicare taxes. That's 7.65% total. And this is why HSAs can potentially provide a greater tax benefit than any other account type I discussed in this video. It's important to note that you can only make contributions to an HSA while you're also enrolled in a high deductible health plan or HDHP. And the eligible minimum deductible for HDHP changes from year to year. In 25, the minimum deductible is $1,650 for individuals and $3,300 for families. In 2025, the maximum annual contribution to an HSA is $4,300 for an individual and $8,550 for families. There's also a $1,000 catch-up provision for HSAs for those that are 55 or older. Now, until you reach age 65, there's a 20% withdrawal penalty for withdrawing funds from an HSA that aren't used for a qualified medical expense. But one excellent feature of HSAs is that once you turn 65, you can withdraw money from your account for any reason without penalty. But you will still owe income tax on distributions that aren't used for qualified medical expenses. So in a way, it works a lot like an IRA or traditional 401k. Now, being able to use an HSA after you turn age 65 is particularly useful When you consider that HSAs are one of the least tax-friendly ways to leave an inheritance to your heirs, because the full balance of the account has to be distributed and taxed in the year it's inherited. The notable exception is spouses who can continue to use the HSA as if it's their own. But if you can, you and your spouse should try to liquidate your HSA in your lifetime if all possible. Or if you're charitably minded, you can actually donate the HSA to charity. They won't actually be exposed to the tax if they're tax exempt like your heirs would. Now, the exception of HSAs, all the tax advantage retirement accounts I've covered potentially accept contributions on either a Roth or traditional basis. And one common point of confusion is that a Roth account is an account type, which isn't technically true. The word Roth refers to the tax treatment of the account only. So in the case of a Roth, taxes are collected before contributions are made, but earnings and withdrawals are all tax-free. A tax-deferred or traditional accounts allow you to make contributions before taxes are withheld if they're made at work, or they provide the opportunity for a tax deduction if you contribute to a plan outside of work like an IRA. So any Roth or traditional account you have is actually a 401k, a 457, a 403b, an IRA, a TSP, something like that. And that account actually receives the Roth or traditional tax treatment. Now, before I explain which tax treatment is best, let me illustrate an important mathematical principle. If the tax rate and the rate of return are equal, then there is no advantage to a Roth over a traditional or vice versa. So for example, just quickly, if you assume you have $1,000 you want to direct into an IRA, and you're in the 12% tax bracket, and you expect the realized rate of return that you invested to be 10% per year. If you make a tax-deferred or traditional contribution, you won't pay tax up front, so you get to put the full $1,000 into the account, which earns $100 at 10% interest, leaving you with $1,100 in pre-tax money. After you pay $132 in taxes, which is 12% of $1,100, you'll have $968. Now, assuming that instead you make contributions on a Roth basis, you'll have $880 available after taxes. That's that $1,000 minus 12%, which is $120. That leaves you $880. If you earn 10% on $880, that's $88. And if you add $88 to $880, you have $968, which is exactly the same amount you'd have if you went traditional. So like I said, same tax rate, same rate of return, same result. But since we can't predict rates of return, and you shouldn't adjust your overall asset allocation just because you're making Roth or traditional account contributions, the factor that really matters here most is your tax rate. Now, the nice thing about having Roth or traditional options is that if your tax rate is different when you make contributions and withdrawals, you effectively get to pick when you pay your taxes. And naturally, you want to pay taxes when you're in the lowest bracket. So if you think your income is lower when you make contributions than when you'll make withdrawals, you should use the Roth account. If you're early in your career and your income is low, this is definitely the way you should go. On the other hand, if you have a high income and think you'll be in a lower tax bracket retirement, the traditional or tax-deferred contributions are the way to go for sure. Now, there are more things to consider between Roth and traditional contributions, but I don't want to belabor the point in this video and make it any longer than it's already going to be. If you want a lengthy explanation of Roth versus traditional, there's actually a video I've made debating that. I'll put a link to it above, and also have a link to it down in the description below. Another item to keep in mind is that you'll probably have access to more than one of the tax advantage accounts we discussed. In fact, only 401ks and 403bs are exclusive of one another, meaning you can't get the same annual contribution limit, that $23,500, across both accounts. I should point out there's a notable exception to solo 401ks, but you'll have to watch my video about solo 401ks to get it, because again, this video is already going to be long enough. Now, with access to such a variety of accounts, each with its own rules and limitations, there's certainly an order of priority that will yield the best financial outcome for you. So now I want to walk through a general ranking or prioritization of these accounts, followed by a brief justification of each one. Please note, this is a very general listing. Like I said, the actual best order will depend on your personal circumstances. And once again, I have a video about prioritizing these accounts, which I'll link them up. Number one is HSAs with an employer match. You get triple tax advantages plus free money from your employer, and that makes this a no-brainer. And second is your employer plan with an employer match. Any employer plan where you're getting free money, could be 401k, 457, 403b, TSP, doesn't matter. If an employer is giving you free money, making contributions on your behalf to the account, that's the next valuable place to save and invest. In third is 457s. Now 457s, 403bs, 401ks, we talked about how similar these are. But 457 gives you the added flexibility of being able to begin making withdrawals upon retirement. You don't have to wait until age 59 and a half like you do with other accounts. Coming in at number 4 is IRAs. They are ahead of other employer-sponsored plans because an IRA gives you complete control over your investment options, where employer-sponsored plans may have small, limited selection of investments that your employer actually allows to be in the plan. In fifth place are 401ks and 403bs and TSPs. Now, they're way down the list, but don't sleep on the benefits of these accounts just because of how low they are. Most millionaires actually clear the 7-figure threshold thanks in large part to their 401k. Odds are you'll actually need this option anyway, as the higher ranked account types above this one, either people have limited access to, or the contribution limits are low enough that you're not going to be able to contribute enough in those accounts to really generate enough for retirement. Finally, coming in at number 6 is taxable accounts. No, there aren't really any tax advantaged aspects to a taxable account, but I'm listing them anyway in case you run out of space in the account types above, so you'll know where to go, because there are also no caps. After all, long-term capital gains are taxed lower than income, so they're not a bad choice if you have nowhere else to turn to invest. Now, options 1 through 5, like I said, all have a maximum contribution limit, but you only need to contribute up to a portion of that amount unless you're just rolling in cash without any other place to put it. I recommend saving 15 to 25% of your income in these accounts in the order that they're listed on your screen. Now, you may ask, why 15% to 25%? Well, in full disclosure, when I first started markmoney.com and I began suggesting that people save and invest at least 15% of their income, I did that because that's the goal that my wife and I had always set for ourselves, and it worked out pretty well for us. However, my wife and I started saving and investing when I was 25 and she was 23. Not everyone has the opportunity to get started that early, and as a result, they don't have as much time to enjoy the benefits of compounding interest. Now, the fact is, the amount of time that you have to invest is a major factor in how large your nest egg will grow. If you can't get started early in your career, then you'll need to play a bit of catch up later. So in an effort to figure out just how much you need to contribute in order to retire with a portfolio capable of reproducing 80% of your pre-retirement income, I did some math and recorded a video about it, which again, I'll link above. Now, the basic goal of this whole post and video was to find suggested savings rates as a percentage of income based on the number of years you are from retirement and an expected rate of return. So if you have this information, it allows you to see how much you need to save now to retire any of number of years in the future. So if you're able to save 25% of your income for 20 years and achieved an annual or average rate of return of 12%, you could retire with a portfolio that replaces 80% of your pre-retirement income. Also, saving just 15% of your income for 37 years at a modest 6% would produce the same result. Now, naturally, some people start investing early and some people start late. Some people invest aggressively, some invest conservatively, but everyone needs some idea of how much to save in order to retire. The table provides that information. So to summarize, if you start saving and investing in your 20s, you'll probably do just fine if you set aside 15% of your income. If you start in your 30s, I'd bump the savings rate up to 20%. And if you start in your 40s or later, you better make it 25% or more. Now, if you look at that range of 15 to 25% and say to yourself, I actually have much more than that, well, I've got good news for you. We're going to tell you where you should or shouldn't invest that in milestone number 6, which is next on the roadmap. As always, I am grateful for your time and your interest in my videos. God bless and take care.